Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are investment-savvy mortgage brokers and buyer's agents. We help clients all over Australia build property portfolios. In this episode, we'll be discussing how the finance industry focuses on the low rate, fees and charges as opposed to a big picture focus. We will also be shedding light on investors losing tax savings and also getting stuck with high-risk loan structures, choosing the wrong lenders at the wrong time. Lastly, investors also get unqualified advice from family, friends, and property experts who are not licensed to give them credit advice. Finance is the most important part of building a property portfolio, but many people think that property comes first and finance comes later. It's incredible how many times people come to us with bad loan structures and they're stuck because they're unable to actually move forward. Often with finance, people are only really thinking about just getting a loan. That's because the finance industry is designed to be quite transactional, whereas it's so much more than that. Well, what happens is they either get stuck with just one property and not able to move forward. They lose on tax savings. And also, many people take a lot longer to pay off their home due to the poor loan structuring. And lastly, many people give away the control of their portfolio to the bank and get stuck. And the cost for this runs into hundreds and thousands of dollars. The finance industry is just focused on getting the lowest rate, product, fees, and charges. There's never a focus on the big picture. And what that means is most people just get stuck and not able to grow their property portfolios, or they're staying with bad structures as a result. So you might get a basic product with a really low rate, but you may miss out on an offset account. By not having an offset account, if you wanted to save on interest, you either have to park your savings into the loan or the redraw, which has an income tax implication, and the ATO may perceive as that loan being paid down. On the other hand, if you don't have an offset account, then you miss out on interest savings. Something to note is that a few years ago, back in 2019, 2020, one of the bank lenders went and took about 20,000 their clients' money and reduced the redraw balances. So the bank effectively controls that cash. And also, being with a basic product, the bank may not have flexibility to be able to tap into the equity, and this will inhibit your ability to be able to progress and build a property portfolio. Consider getting a loan that gives you the flexibility, potentially with an offset account. Sure, it might cost you a little bit more, but what you need to think about is if this property is an investment property, are you maintaining the tax deductibility of your loan? Of course, subject to your tax accountant's advice. And also, if this property may not be your investment, but a home where you live, however, you plan on converting this property into an investment property down the track, then does it make sense to continue building up your savings in an offset account for a future family home, and therefore this property as well in the future maintains tax deductibility? You do need to seek the right credit and tax advice to ensure you are getting that right product, but it's prudent because so many times we see people where they've impacted the complete deductibility of their loans because of this setup, even though they might just save a little bit of money right now, but it will really cost them over the longer term with poor structuring. What you need to know is the rate is cheap now, but what is the opportunity cost? Do you have the flexibility to be able to tap into the equity of the property? Would the lender allow you to access equity so you can build a property portfolio? Are there income tax implications of having this cheap rate and not having an access to an offset account? And one of the key ones that we see is, when you're paying lenders mortgage insurance, is it the right lender for you, which will actually enable you to expand your property portfolio down the track? Because many lenders are quite inflexible when you have paid LMI, whereas there are some instances where you have paid LMI and you may still be able to tap into the equity and be able to progress with your property portfolio. Talking about a scenario that we came across So we had this couple contact us towards the end of 2020 to say Adam and Mary. And Adam and Mary had 3 dependents and family income of about $300,000. So we did a finance strategy for them whereby they would have been able to tap into the equity of their home for about $50,000. And they also had $160,000, which they could have used tax effectively through restructuring of their owner-occupied loan. And this would have funded to $630,000 investment properties, assuming they paid lenders' mortgage insurance, to a total of $1.26 million. However, they chose to not follow this path at that point in time, and Australian property prices have risen significantly over the last few years. So considering the lending climate today, there's tighter borrowing capacity and property prices have risen so much, so they won't be able to buy the same caliber of property as of now. So instead, what they did was they went for a low rate and they also chased like a $4,000 refinance rebate. And once they had done that, they were still wondering what is it that they needed to do to start their property portfolio. So they was now stuck with a lender, which is quite inflexible in terms of tweaking the structures of the loan, and they have missed out on all this capital growth. So they could have had a very different result had they not just looked at the rate and the refinance rebate, and instead they would have looked at the actual structuring and how it can actually enable them to create financial freedom and wealth down the track.
So it's been a massive opportunity cost for them. And I would say most people don't realize how important the finance setup is, especially if you are building up your own savings to invest in a proper way and expand your property portfolio. And the markets have gone crazy since. What we also see is most investors choose the wrong lender at the wrong time. They think of the property, everyone's excited about buying that property, but finance comes in as an afterthought. And often people go down the path of choosing the wrong lender at the wrong time.
What this means is, you might get stuck with a lender which is not willing to release equity down the track, which is fuel to build your property portfolio, or even the lender may choose to control funds. And also some lenders are quite inflexible, which means you may miss out on potential income tax savings down the track. The opportunity cost of getting the wrong structures runs into hundreds of thousands of dollars over the long run.
So the right way of doing this is having an upfront finance strategy, mapping out your portfolio upfront. And for that to happen, we do what's called valuation shopping for our clients, where we see which lenders are portfolio friendly or portfolio building lenders and make sure we have the right valuation so our clients are able to actually maximize the equity. That way you're choosing the right lender in the right order. And then we move on from the more conservative lenders to more lenient lenders to maximize opportunity, maximize the equity our clients can access, and also be able to move from one property to the next. It's really best practice to tap into the equity. It's interesting how many times people say, oh, well, I don't want to access the equity right now. And can we do it later? Can we do a pre-approval and just go buy that investment property? But really, you need to make sure the finance is set up correctly up front. You've chosen the right lender that helps you do that, and that way you have a foundation to expand your portfolio. It's especially prudent when you have a lot of equity in your home or an investment property. So make sure you're set up right at the start and move from there onwards.
What you need to know is that lending climates keep evolving and property markets keep moving. So the finance strategy actually needs to be revisited over a period of time, and it's fluid and it needs to be tweaked as time goes on. So you need to be able to navigate from bank lenders all the way to non-bank lenders and go through all the tiers until you exhaust your borrowing capacity. Time is going to pass anyway, so you need to just weigh up the opportunity costs versus being able to take action and going to some of the non-bank lenders. You need to factor in the higher interest rate that comes with it. But as property markets grow, that cost will be minuscule.
We've had clients over the course of Property Twins' existence who started, say, in 2017 with their first homes, or even if they owned a home and bought their first investment property, and over this time expanded their portfolios from one property to the next. And we've really just navigated the lending climates as rates have gone up, rates have gone down, lending policies have changed, and bank appetite has changed, we really continue to revisiting their portfolio. And that's how you keep moving forward from one lender to another over the course of your journey and continue building your property portfolio.
What we see is many people go get unqualified advice from property advisors, their family, friends, and colleagues. And this does not even take into account their personal circumstances. And often we hear in the property industry, which includes buyers agents, coaches, gurus, spruikers, talk about buying 10 properties in 10 years, saving tax, pay off your home in 7 years, all the marketing gimmicks. But they are inadvertently giving credit advice, which may not be applicable to your circumstances. You need to seek specific credit advice suited to your circumstances.
Well, at least though it sells the dream, isn't it? Building that scalable portfolio that we often hear in the marketing space in property. Again, the credit side is really ignored, that this is credit strategy. Property really is just a vehicle to access finance, and finance is what builds portfolio. If you can't get the finance, you cannot build that property portfolio. Another thing to note is also bankers, where bankers focus just on their own product. They rarely have a big picture focus as to what are the implications of the actions that you take today. How would that impact your property portfolio over the longer term? Then people talk to their friends, colleagues at a barbecue and then follow their advice. And these friends may have never built a property portfolio. They might have bought a property, formed an opinion about a lending product their ways. But really, if they haven't seen the whole journey, then be careful who you're getting your advice from.
So getting this unqualified advice will leave you confused. So many people, when they come to us, they are like, how are other people able to build a particular property portfolio? And they're confused as to why they are actually stuck and unable to move forward. And many have said, oh, my friend got that interest rate. Why do I not have that rate? Or why am I getting a higher rate? What they forget or what they miss is that every individual circumstances are different, and you need to get tailored credit advice that suits your circumstances to be able to take action. Don't work off what people are telling you that this is what their portfolio looks like, because you don't know the inside story.
It's really about navigating the finance setup right from the start. It's not get rich quick scheme. You just have to keep revisiting your finance strategy and keep valuation shopping, seeing if your structures are still optimal, and continue expanding your portfolio. And really, if your friends, colleagues, or some of the property experts have not trodden that path, how do you know if they can really tell you if you're on the right track? So make sure you get that right advice with setting up your finance correctly from the start.
So when you get this unqualified advice, or you see these advertisements saying, build a scalable property portfolio, buy 10 properties in 10 years, or pay off your home in 7 years, you need to know that there is more than meets the eye. These are just generic statements, and it may not be applicable to you. So it's vital that you seek specific credit advice tailored to your circumstances so that you know how your property portfolio can pan out. Are you able to buy one investment property, 2, 3, whatever the number may be? That all forms part of your finance strategy, and we map that out for our clients. Just note that lending evolves over time, and as interest rates go up or down, the lending will either tighten or loosen. So you need to navigate that over a long period of time. It won't happen overnight. It may not be buying 10 properties in 10 years. It might be a realistic target of, say, buying 3 properties over a set number of years.
We also see investors losing tax savings through poor loan structuring and also selecting the incorrect repayment type. If you own a home and an investment property, you need to be really mindful what sort of repayment types you're selecting. And maybe you just own an investment property. You need to make sure you are paying the right repayment type again, so you can plan to buy a home in the future.
So what this means is that you lose income tax savings. So more often than not, we see people or investors who come to us and they have bought an investment property, and what they've actually gone and done is they've pulled money out of their owner-occupier offset account and put a deposit on that investment property. This is incorrect way of doing things, because you can tweak the structure of your owner-occupied loan to be able to use your cash savings tax effectively. Alternatively, you may also be able to tap into the equity. Even if, some investors have equity. They don't want to tap into the equity of their owner-occupied property because they believe that they'll be increasing the loan of their owner-occupied property. This is quite tax ineffective and will lead to you losing tens of thousands of dollars in income tax deductions. When it comes to repayment type, so the impact of choosing the wrong repayment type is that you may actually take longer to pay off your owner-occupied loan. So you need to really weigh up whether principal and interest repayments are more suitable to your circumstances or interest only. All of this needs to be decided by keeping in mind your long-term goal and what you are intending on doing down the track. It's no one-size-fits-all approach. It's specific to your needs and objectives.
And you don't know what you don't know because we've had clients who've started with their first homes. Let's call them Jane and John. Jane and John bought their first home and then they built up around $85,000 in cash savings. They didn't have enough equity in their owner-occupied property at the time. And what we did was we restructured their owner-occupied loan so they could use this 85 grand tax effectively as a deposit towards their investment property purchase. Well, in simple terms, what this means is they would save up to $15,000 in tax over the life of that loan. And when you pull that money out of the offset and put a deposit towards an investment property without restructuring your existing home loan, you're losing out on those $15,000. And most people are not aware of that, the flexibility that you need as part of that.
And I'd like to also add that lender selection for their owner-occupied property was quite vital because if we had gone to a lender just because a lender offered a lower rate, they would have not had the flexibility to be able to tweak the structure of their owner-occupied loan to use these $85,000 tax effectively. They would have lost out on these $15,000 of tax benefits down the track. So you need to keep in mind what your goal is and choose the lender in line with that goal because that's going to make or break your future property portfolio. So you need to make sure that you choose the right repayment type for the debt, whether it's owner-occupied or investment. So these repayment types would either be principal and interest or interest only. If you have a home, then you need to prioritize paying that off in the first instance. You need to make sure that you are looking at any income tax implications associated with you paying off an investment property and also seeking specific tax advice from an accountant who can help you maintain the tax deductibility of your loans.
We see property owners get stuck with high-risk loan structures such as cross-collateralization. Cross-collateralization is where you link two or more properties, and what happens financially to one property impacts the other. So you might not be able to tap into the equity of the property. It might be an issue when you come to selling the property and just making overall a difficult process to access finance when properties are linked together.
Bankers are actually encouraged to cross-collateralize properties because this gives the bank more control over your assets. The way to figure this out is you look at your loan application, which may list both your properties on there. Alternatively, you can also look at your loan contract, which would typically list both properties on there. Effectively, this is you giving away control to the bank because if you want to refinance or sell one of the properties, the bank will then value both properties just to make sure that the valuations stack up. And this could be a bit of an issue if valuation for one of the properties has pulled back.
It's also high risk because the bank might say, well, you're selling one of the properties or refinancing one of them, and now we want to reassess if you can actually afford the loan for the property that's staying with the lender. And as we know, lending climates change, rates rise. Would you be able to do that in the future? And your life circumstances may have changed as well. So many times people are just not able to service for that same loan. So what that means is you just can't refinance or tap into the equity, and therefore you're just stuck with the lender, not able to expand your portfolio because of how they might value two properties, how they might assess your borrowing capacity, and literally the control for the equity and any profits sits with the banks.
uncrossing properties can be a time-consuming and costly process. At times, it may take quite a long time. We've actually helped some of our clients in the past uncross properties, and it was quite a stressful process because they had paid LMI and we had to leave one property with one lender and refinance the other. So there's a lot of intricacies that we need to tick off as part of that process. So better not to cross properties on the front end. Don't think of this as, it's easy to do this now. I'll just go ahead with this. I'll fix it later, but there are no guarantees that you'll be able to fix the structures later. It's only a problem when it's a problem.
We've also had clients who've come to us specifically asking to help them uncross their properties because they've seen their friends who've gone to sell a property and they had cross-collateralization between their home and the investment property, and they were left with no profit from the sale. The bank took the entire profit before they even had the dibs on any benefit of having that investment property. And that was purely because the bank valued their other property and possibly the valuation didn't stack up. And these people didn't even see any profits. And the bank took it all, the equity from the sale of the property.
So just make sure that you get the structures right on the front end rather than fixing them down the track.
To sum it up, get the loan structuring right from the beginning. Make sure your property portfolio is mapped out right from the start and you're actually navigating this process over a period of time. And also make sure that you are setting the loan with the correct repayment types and you are taking into account any tax implications that might happen in the future. And you need to really do that with your broker and your tax advisor who can assist with setting up your loans correctly.
Focus on minimizing risk and maximizing flexibility with your loan structures because this is going to impact you long term. Focus on the big picture rather than the small benefits that you might be getting along the way, such as a low rate. Eventually, most people want to generate wealth so they can have financial freedom, security and stability and generate passive income. If you can access the right loan structures and expand your portfolio, that should be your focus.
Basically, you need to really rank out what's important to you, right? Between the rate, fees and charges, loan structuring. And that's not to say don't minimize what you're paying to the banks, but really making sure you're getting the best of both worlds, not just minimizing interest, but also the ability and the flexibility to expand your property portfolio so you can move from one property to the next and the one after that.
Thank you for listening. Join us next time for another episode of Property Addicts Australia podcast.
Thanks for listening to Property Addicts Australia. For future episodes, click follow. Leaving a review helps others find the podcast. And for more information about how we can help you, visit propertytwins.com.au.